Microcredit, concept and features. Hey guys, welcome. Today we are diving into the world of microcredit, an essential service for millions of people worldwide. Microcredit provides a small loan to individuals and groups who often lack access to traditional banking services, helping them improve their livelihoods, start businesses, or cover emergency expenses. But what makes microcredit so unique? Let's explore. What is microcredit? So, microcredit refers to small loans, typically ranging from $50 to $1,000 that are provided to individuals or groups who wouldn't qualify for traditional loans. These loans are designed to help people excluded from formal financial systems due to lack of collateral, credit history, or even formal employment. Now let's look into characteristics of microcredit. Microcredit has some distinct features that make it especially suitable for low-income clients. Small loan size. The loan amounts are often small and tailored to the borrower's needs, usually enough to support modest ventures like starting a small shop or purchasing an equipment. Short repayment terms. The repayment terms are shorter than traditional loans. Usually, it will be a few months or 2 years. Frequent repayment schedules. Borrowers make frequent payments. It might be weekly, bi-weekly, monthly, depending upon their cash flows. Low or no collateral. One key feature of microcredit is that it doesn't require traditional collateral like land or property, making it accessible to those without assets. Group lending model. Many microloans use a group lending model where small groups or borrowers take joint responsibility for repaying the loan, guaranteeing each other. Let's look into some of the benefits of microcredits. Financial inclusion. Microcredit provides access to capital for low-income individuals who would otherwise be excluded from the formal financial system. Poverty alleviation. By enabling income-generating activities, these loans help lift families out of poverty. Empowerment of women. In many places, microcredit targets women, offering them financial independence and empowering them to contribute to their households. Support for small businesses. Microcredit can fuel the growth of small businesses, creating jobs and spurring economic development in underserved areas. Interesting scenario. A microcredit success story. Meet Aisha. She started with a dream and a small loan of $100 to purchase a sewing machine. With that, she began saving clothes for her neighbors and her business grew. Over time, she hired 2 more women from her village. Microcredit helped Aisha become an entrepreneur, empowered her, and supported her entire community. That's just one example of how microcredit can transform lives. But Like any financial product, microcredit has its challenges. Despite its many benefits, microcredit also comes with challenges. High interest rates. Because issuing small loans involve high administrative costs, MFIs sometimes charge higher interest rates than even traditional banks. This can strain the borrowers. Over-indebtedness. Some borrowers take multiple loans from different sources, making them difficult to repay them all, leading to a cycle of debts. Loan use monitoring. Not all borrowers use loans for income generating activities. Some use them for consumption, which can hinder their ability to repay. Individual credit. While microcredit is often provided through group lending models, some MFIs offer individual credit tailored to borrowers' needs. Let's take a closer look at this type of loan. Starting with definition of individual credit. Individual credit is a loan provided directly to the borrower without group liability. It's typically given to individuals with more stable incomes or a proven credit history. Features of these individual credit. Here are the features that make individual credits unique. Customized loan products. Loans are tailored to the specific needs of the borrower based on their cash flow, business, and repayment capacity. Collateral or guarantees. In some cases, MFIs may require collateral such as personal or even business assets. Higher loan amounts. These loans tend to be larger than group-based microloans. Flexible repayment schedules. Repayment terms are often more flexible, aligning with the borrower's cash flow. For instance, small farmers might need a loan during planting season, but won't have the funds to repay until after harvest. Here, MFIs offerings individual credit can adjust repayment schedules to fit these seasonal cycles, ensuring the loan is both affordable and timely. Challenges of individual credit. But as with all loans, individual credit comes with its own challenges. Higher risk for MFIs. Since there's no group guarantee, the MFI bears more risk. Need for credit assessment. Individual loans require thorough credit assessments, making the process costlier and time-consuming. Limited access. Because of the need for credit history or collateral, individual credit may not be accessible to the poorest clients. Microfinance uses innovative methods to assess credit worthiness for clients who lack traditional documentation. Two of these methods are character-based lending and cash flow-based lending. Now let's look into character and cash flow-based lending. Microfinance uses innovative methods to assess credit worthiness for clients who lack traditional documentation. Two of these methods are character-based lending and cash flow-based lending. Now let's look into character-based lending. Character-based lending evaluates a borrower's personal reputation and trustworthiness, relying on community relationships instead of formal credit scores. Social capital. The borrowers standing in the community is considered as a collateral. Credit worthiness through trust. MFIs may interview community leaders to assess trustworthiness, reputation-based systems. Previous repayment history with the MFIs can also play a crucial role here. Cash flow based lending. In cash flow based lending, MFIs assess the borrower's income generating capacity, reviewing their current and projected cash flow. Income assessment. The borrower's cash flow is evaluated to determine repayment ability. Loan repayment based on income cycles. Loans are structured around the borrower's income cycles, making repayment more manageable. Interesting scenario on cash flow based lending. Consider a street vendor who sells fresh fruits daily. Her income fluctuates, but based on her consistent sales, the MFI offers her a loan with weekly repayments that align with her cash flow. This flexible loan structure allows her to grow her business while making affordable payments. Moving on to group lending models. Lastly, let's discuss group lending models, a cornerstone of microfinance. Group lending helps individuals who lack collateral by providing social guarantees through group liability. Joint liability in group lending. In group lending, all members are jointly responsible for each other's loan repayment. This creates a strong peer pressure to ensure everyone pays on time. Peer pressure for repayment. The group's future access to loans depends on everyone's ability to repay. Self-selection of group members. Groups are self-formed, often composed of trusted peers, reducing the risk of defaults. Social capital as collateral. Instead of physical assets, the group's social ties serves as a main guarantee for repayment. In conclusion, microcredit, whether delivered through group lending, individual loans, or character and cash flow based lending, is a powerful tool for financial inclusion. It empowers individuals, supports small businesses, and strengthens communities. While each lending method has its benefits and even the challenges, the diversity of microfinance credit, I hope this session has given you a deeper understanding of how microcredit works and the critical role it plays in promoting financial inclusion. Thank you for joining me today, and I look forward to continuing this journey of learning with you in our next sessions. Keep exploring, keep questioning, and see how these concepts can shape the world of microfinance. Thank you.